Hey, let's talk about the difference between Rogers APY, Treasury bonds, and the Fed funds rate. This isn't just financial jargon, it's about where you can put your money and what kind of return you can expect. First, let's look at Rogers APY. Roger is a digital bank specifically for the US military community. Their savings accounts offer a high annual percentage yield, or APY, which, as of late, has been around 4.12%. APY is the real rate of return on an investment over a year, taking into account the effect of compound interest. A high APY is a major selling point for online banks that don't have the overhead of traditional brick-and-mortar institutions. When you see this high rate, you're looking at a pretty solid, low-risk way to grow your savings. The money is FDIC insured, so it's very safe. Now, let's pivot to Treasury bonds. Classical building these are debt securities issued by the US government to fund its spending. Think of it as lending money to the government. The return you get on these is called the yield. Treasury yields are generally considered the benchmark for risk-free investments because they're backed by the full faith and credit of the US government. The yields on these bonds change constantly, influenced by market demand, inflation, and the Federal Reserve's actions. The longer the bond's maturity, say, a 10-year Treasury versus a 3-month Treasury bill, the higher the yield typically is to compensate investors for the longer time horizon. So, how do they compare? Rogers APY is a specific, high-yield rate on a savings account, which is designed for easy access. Treasury bonds are a market-based investment. You're not just saving your money, you're buying a security. Their yields are a reflection of the broader economic outlook. A bank like Roger can offer a high APY partly because they're competing for deposits and can adjust their rates quickly in response to market conditions, which are, in turn, heavily influenced by the Fed. And that brings us to the Fed funds rate. This is a target interest rate set by the Federal Reserve. It's the rate at which banks lend their reserve balances to other banks overnight. The Fed doesn't set the APY on your savings account or the yield on a Treasury bond directly, but the Fed funds rate is the foundation for all other interest rates. Bar chart: when the Fed raises this rate, it makes it more expensive for banks to borrow money, and that cost gets passed on to consumers and investors in the form of higher interest rates on things like mortgages and car loans. And it also pushes up the rates banks offer on savings accounts and the yields on Treasury bonds. When the Fed lowers the rate, the opposite happens. So, Rogers APY is a high-yield savings rate, a safe place for your cash. Treasury bonds are a government-backed, low-risk investment with a market-determined yield. And the Fed funds rate is the ultimate lever the Federal Reserve uses to influence all other interest rates in the economy.